Hello friends, in this video I would like to tell you whether it's possible to use Fibonacci levels in scalping and how to do it most effectively. Fibonacci levels are most often used in investing and very long trades, but thanks to the fractality of the market, we will show how it works on lower time frames. Fibonacci levels are horizontal lines that indicate likely support and resistance. They are based on Fibonacci numbers. Each level is associated with a percentage. The percentage is how much of the previous movement the price has restored. Fibonacci levels are 23 and 6%, 38 and 2, 50%, 61 and 8, and 78 and 6%. Some traders use such a significant level as 50%. This is the classic interpretation of this tool. I see no point in going into the mathematical details of its origin, so let's get straight to the point. What should be taken into account first of all? As with indicators, we should not take Fibonacci levels as an unconditional factor for entering a trade. Any level can face false breakout with the price rolling back, and sometimes when moving on the news or pumps, it may not be respected at all. This must be taken into account. What conclusion could be made? Fibonacci levels are exclusively an additional analytical tool that can be used to find an additional argument for entering a position. Nothing good will come of trading from Fibonacci levels without being guided by anything else. Further, construction rules and areas of application. We stretch Fibonacci levels, capturing a wide range, from a minimum to maximum, or vice versa, from a maximum to a minimum, if we are looking for a correction reversal point. The older the time frame, the more effectively the Fibonacci levels are observed. So they are more effective when analyzing instruments for investment. But since the market is fractal, we can use this tool from 15 minutes time frame. And most importantly, a combination of factors. Having found a situation for a scalping or positional trade, we should understand that the primary factor should be borrowed from technical analysis and order book analysis. If the breakout of a Fibonacci level or a rebound from it coincides with other factors obtained from a chart or order book, for example, limit orders, points of control, reversal formations, then the Fibonacci level can serve as an additional factor for us increasing confidence in this setup. So let's see several trades using Fibonacci levels on a practice. Atom USDT, here we see the price coming to the strong local resistance. Here I decided to use Fibonacci levels to find the point where I can load in advance before the breakout. Look at this area. It was respected by the price, and the price hardly went lower. I decided to load the position in advance from this level. Due to this useful tip, I managed to load in advance, and I had already a profit of almost 1% before the breakout. The delta was absolutely green, showing us the intention of buyers to break the level. Finally, the breakout process is in force. The buyers are extremely active, but the breakout itself only showed a 0.5% of movement. However, due to our useful tip of loading from Fibonacci level before the breakout, we managed to increase this potential 4 times. The next instrument was GAL USDT. I was waiting for the breakout of 23% of Fibonacci level. As you see, the sellers were quite active, and I was loading in advance from this level. That's how we could trade between Fibonacci levels. The level 2.33 was the historical lows where I supposed the price should go. The potential of movement was about 4%. As you see, the breakout was in the process, but I removed the stop loss in the break-even point, and there was a stop loss hit. The situation gave me $18. But finally, the breakout of this strong local support occurred. Then there was the retest, and then the price continued the downtrend movement, 6 and 4% in a moment.